Hi everyone, welcome to the official launch, the hard launch as we call it in the office of the Strategic Opportunities Growth and Income Fund. It is such a pleasure and an honour to be with you tonight. Thank you to those who've been assisting us with the soft launch over the last couple of weeks and helping us to iron out the bugs in the system, of which there's been a few, but lots of them have been ironed out as well. The lawyers will lynch me if I don't start with the required disclaimers, so read along with me. This information is of a general nature only, does not take into account your objectives, financial situation, or needs. You should consider the product disclosure statement issued by PCL in deciding whether to acquire an interest in the Strategic Opportunities Growth and Income Fund. Past performance is not a reliable indicator of future performance. No earnings estimates are made. Any discussion of forecast profitability, distributions, redemptions, etc. are derived from unaudited financial projections. Such forward-looking statements are not guarantees of future performance and involve known and unknown risks, uncertainties, assumptions, and other important factors, many of which are beyond the control of the responsible entity. The responsible entity does not, cannot give any assurance that the results, performance, or achievements expressed or implied by those forward-looking statements will actually occur, and investors are cautioned not to place undue reliance on these forward-looking statements. All right, thanks for bearing with me as we run through that. Tonight, we're going to cover part one about the opportunity that we've put together. Part two, we're then going to talk, part one, we're going to talk about opportunity in general. Part two, we're going to talk about the fund. We're going to have a short interval so I can go and get myself a drink. And then for those of you who want to stay around, we're going to do an encore, which is run through the application process so people know what to do in order to get started with their application. Be aware that you can download tonight's webinar as a handout. In the handouts area, there is a PDF file available. Special shout out as well to everyone who's watching the recording. Thanks for watching the recording. Sorry you couldn't be with us live. If you have any questions as we go through, my team in the office, Paul and Elena, are both ready and able to answer any questions that you may have. You can put them into the question box. There'll also be some dedicated Q&A time later on during the webinar. Remember, this is being recorded, so if you have to jump in or jump out to something else and you want to pick up what you missed, you will be able to. Just give me a couple of days to render the video and get it uploaded, and then I'll send everyone out a link. Cool. Well, for those of you who aren't familiar with who I am and my so-called claim to fame, let's run through it really quickly. I went to uni and qualified as an accountant, Bachelor of Business and majoring in accounting, and then I went on and became a chartered accountant, did the extra postgrad study required to qualify to become a member of the Institute of Chartered Accountants of Australia, and then promptly said, I don't really want to be an accountant. And it was May 1999, and I'd started an accounting practice with Dave Bradley. He and I decided that we would use the money he made in the accounting practice, and I would go out and buy property with it. And so in May 1999, we bought our investment property, and between May 1999 and 2004, over that 5-year period, Dave and I managed to buy enough property so that we were both financially free. That's the story of 130 properties in 3.5 years, which was the tale that was recorded in my first book. Since 2004, I've continued to raise a family, and I mean, what do you do when you're financially free? You work because you want to, not because you have to. And so I've had the opportunity to train millions of people all around the world on how to create wealth using real estate, which was, of course, my vehicle to get out of the rat race. And then in 2012, after buying hundreds of properties in the United States myself, I put together a managed fund where we would pool our money and go and buy commercial property in the United States. And here we are in 2023, and that US fund is winding up. I said I'd do it for a decade, and the decade has wound up. And so as that fund winds down, we're now at the very early stages. In fact, tonight we are celebrating the official launch of a second fund. And this fund will be Australian based, as we'll talk about tonight. Part one, opportunities. So this is general education, investing education. And what I want to try and share with you tonight is a little bit of information around why it is that some people take advantage of opportunities and why it is that others don't. So the first thing I'd say is I reckon this slide is 100% true. You miss 100% of the shots you don't take. Before I blew out my right knee, I used to play a lot of basketball, and I quickly learned that you can't score the winning goal from the sub bench, right? And you will always fail. There's a 100% chance of failure if you never try to begin with. And so when it comes to opportunities, sometimes we have a habit of talking ourselves out of things because we get focused on all the things that could go wrong, and we don't properly evaluate those things that could go wrong. We don't attribute risk ratings to them. We don't manage and mitigate them. It's just a end of the world, top of the world kind of scenario. So I wonder, if I was to ask you a question early on in the webinar, what's an opportunity that you didn't take that you wish you had have taken? And similarly, what's an opportunity you did take that you wish you didn't take? And what we try and do is we try and look at the mindset involved in the decision that you didn't take, that you wish you did, and the mindset involved in the decision you did take that you wish you didn't. And normally what we find is people overthink the decisions they didn't take and underthink the decisions they did take in Regret City. What do we learn? We learn that we can still make good decisions, but it's the amount of due diligence behind the decision that is all important. So 10 years ago, when I was raising money for the US fund, I showed this slide, and some of you may remember it on tonight's webinar. What I said is, you need to make a choice between joining me in the mine of opportunity. I'll go to the mine, I'll dig out the mine, I'll put it in the cart, I'll bring it to the surface, I'll put the money in your bank account. You just need to come along with me. Or you can join the line of regret that you didn't jump in on the opportunity. And a consistent theme that I've been told time and time and time again with the US fund is, I wish I had got in it if I wasn't, and I wish I had put more in if I was in the first place. It's the same story over and over again. So here we are at the dawn of a new opportunity, and I say the same thing to you as I said 10 years ago to those people who were around then. We have a choice. You can join me in the mine, or you can join the line later on of people who regret missing out on the opportunity. And tonight, I'm not asking you to make a decision impulsively. I want you to have all the facts laid out before you so you can make an educated and informed decision. And if you do make that decision, and if you do decide that this opportunity is something that you want to take advantage of, I want to explain how you jump on board and get in almost from the very start. Because what I don't want is for you to see this opportunity sail off and wish you had have got on it and didn't. Because that would be a shame, right? So there's an opportunity just ahead, just around this corner, if we're ready to take advantage of. And of course, you're here tonight or watching the recording because you want to learn more about what this opportunity actually is. So what is the opportunity? The opportunity on offer is a passive opportunity. It's not an active opportunity. By passive, it means that you can participate without actually having to do any of the hard work. In fact, the hardest work you'll have to do is your application. Beyond that, the distributions will be deposited straight into your bank account or reinvested. You'll get regular updates on what's going on. And you'll also have the opportunity, as I'll share later, to learn from what's going on to improve your skills. But you won't be getting phone calls in the middle of the night. You won't be having to worry when things don't go right. You won't be having to worry about the compliance and all the other death by detail things that go on when you have to run a fund or an investment. And that's actually attractive because for those of you who do your own investing, you know that it comes with a certain amount of aggravation. And as you get older, that aggravation becomes less and less attractive. When you're young and you don't have much money, you're happy to pile on the aggravation for the hope of making profit. But as you get older and you're busy and you've got kids and you're focused on other things. You don't want the hassle of having to run your investments. So this opportunity is what we're calling a strategic opportunity. When Paul and I put this fund together and we came up with the name of it, we didn't just want it to be an any opportunity fund. We're actually very strategic about the things that we want to invest in and the reasons why we want to invest in them. For reasons I'll explain a bit later on when we come to the fees, you'll see that this is a real investor-focused opportunity. We're not a managed fund that is being set up for the sake of our shareholders. We're not a managed fund that's being set up for the sake of our corporate behemoths. We're not a managed fund that is being set up because we need to increase our cap base because we plan to list. We are a managed fund set up by investors, for investors, with investors. Like this investment vehicle is my primary investing vehicle moving forward. I am wedded to make this work as much as I can make anything work. I am $5 million invested into this particular opportunity. This isn't just a little bit of play change for me. I am full on as an investor into this fund. There's expert management. So we're not just a couple of people that have come together and gone, oh, why don't we have a crack at this? We've been running managed funds now for over a decade and have an established track record of being able to deliver. And then what I love about the opportunity is, like we did with the US fund, this is an opportunity for you to learn while you earn. If you want to be a better investor, if you want to learn the lessons, if you want to see what we're doing and sort of why are you doing that, then we run these regular webinars and opportunities to meet up, talk through the financial statements, so that you can become a better investor through the process. So while it's passive, for those of you who want to learn, it's like free seminars every 6 months for you to be involved. And some people say that's really helpful. So let's keep talking about this opportunity. And as we do, I want to talk about the efficient market hypothesis. Now, some of you might be thinking, what on earth is that? It's actually an economic concept. Remember, economics is more to do with social science than it is to do with mathematical science. So these people get together and try and figure out, why is it that humans behave the way they do around money? That's what economics is. And so some bright spark came up with this theory, a hypothesis, that states that all share prices in transparent markets, it doesn't say that, but all share prices reflect all information and consistent risk to return generation is impossible. What does that mean? So if you've got a market, which is a fluid market, like a listed stock market like the ASX, then all the information to do with the shares that are priced in the ASX is priced into that stock already because the information flow is efficient. And so the alpha, the risk above return, right, risk above benchmark return, it's impossible to outperform the market consistently. You might get little bits here and there, but because the market's so efficient, you're not going to outperform the market, which is why you have these studies over and over and over again of monkeys and people throwing darts at dartboards, and more recently ChatGPT getting as good or sometimes even better results than these so-called highly educated experts. What do we learn from this? What are the principles of the efficient market hypothesis that you and I can take and try and apply to our investing? I'm glad you asked. Here they are. The first principle that you can't get away from is that risk and return are related. If you want to get a return but you're not willing to take the risk, it's unrealistic, yeah? And sometimes if you want to get that higher return, you have to look for where the risk is, because risk and return are related. So that means that in efficient markets, where the returns tend to be a little bit lower, you will get an efficient return from an efficient market. So how do you get a return that is more than what you might be able to get in an efficient market? Well, you don't have to be too smart to figure this out. You need to go into an inefficient market where the information flow isn't as fluid and where one person's skill and expertise can allow them to earn a greater profit than just everyone participating in the market. So the higher returns can be found in the inefficient markets, but, and this is very important, with that higher return comes higher inherent risk. Yeah? So I've come up with this concept, which I'd like to share with you, called the profit stack. And as we go higher and higher up the profit stack, what we find is that the return goes up, but also the risk goes up. So at the very bottom of the profit stack are risk-free investments. Now, risk-free investments tend to be government bonds because the government can always print the money to pay you back. And because they're risk-free, the returns are very low. When you move beyond risk-free, you move into low-risk investments. And low-risk investments tend to be your cash deposits, such as term deposits with a bank and bonds with very, very, very highly rated corporate organizations or government bonds, etc., as we spoke about before, but aren't necessarily guaranteed. And then we move up into what's called the efficient market. The efficient market would be a listed market in a well-regulated country where there are specific rules about reporting and information sharing to try and ensure that it's very hard to do insider trading and that the information is shared between the owners and the market very quickly. Then we have at the very top of the profit stack, the inefficient market. The inefficient market is something like direct real estate, where one person's problem can be another person's solution if that other person has the skills and expertise to be able to solve the problem that the owner currently is unable to do it. And they make a profit from doing that. Problem plus solution equals profit. Now here is the aha moment, I think, for many people watching tonight's webinar, right? When you're looking at your own situation, what I would encourage you to do is quickly draw out this profit stack on a bit of paper in front of you and then attribute the capital that you've got currently placed in the market into each of those categories and see what the results show. Whether or not your risk to return relationship is properly weighted for your age and your circumstance. Because what we're trying to do, and we'll share this in a second, in this new fund is to look at this profit stack and come up with our ideal mix at each one of these levels. For instance, if you're chasing return at the moment, but you've got all your investments in risk-free and low risk, there's an incongruency that's going on. Or if you've got all your money placed in the efficient market and you're chasing return, but you can't really tolerate the risk because maybe you're getting a bit older or something else is happening, then you've got the wrong asset allocation weighting. A lot of people just place all their money without understanding that the secret to investing and making the most money in the quickest time for the least risk and the lowest aggravation is to understand this concept of profit stack and weight your portfolio according to your return to risk dynamic. And that's the big aha here. So the conundrum that we face as investors is this: how do you lower the risk and get that higher return in inefficient markets? How do you do that? How do you get the higher return without taking the higher risk? What can you do to practically manage and mitigate the investment to bring down the risk rating without impacting the return? I'm glad you asked. Here are the ways you do it. First of all, it comes down to the strategy that you're pursuing. Rather than relying on luck, you rely on the plan, the systems that support what you're doing, rather than just making it up as you go along. There's a really good book called Atomic Habits. Some of you may have read it, by James Clear. James was in Melbourne yesterday and Paul and I went along to his little presentation. And he has a really good saying that your habits are only as good as the systems that support them. And if you don't have any systems, then your habits can be all over the shop. So the first question I've got for you is, as an investor, how strong is your strategy? The next thing is skill. So you can have strategy, but if you can't execute that strategy successfully, well, then you lack the skill, yeah? So skill is something that is part learned, part gained through experience over time. I could sit down with you all day, every day, and you could read 100 books on how to drive, but that won't necessarily make you a skilled driver until you get on the road and have that next point, experience, so that you get the feel of it. And it's the ability to be able to read situations and scenarios that will help you to apply your skill to the strategy, which then brings us to the last point, which is the due diligence that you do so that you try and uncover as many of the facts as you possibly can before you get in. And friends, this is where the rubber meets the road. The act of investing is not the act of buying assets. The act of investing, right, is the strategy, skill, experience, and due diligence you bring to the task of what do I buy, what do I hold, and what do I sell. And you will be a better investor as you work on your strategy, your skills, your experience, and your due diligence over time. That's what I've learned after, 24 years now of doing this as a professional investor. How are we going? Are we enjoying this so far? I'm going to pause and have a little sip. Anyone out there? All right, Adam's liking it. Good. Nick, hi. Sharon and Ollie, you're still awake. Good. All good. It's all good even the second time round. All right, thank you for your feedback. So what is the SOG of profit stack? Well, the SOG of profit stack looks like this. We're going to have some government guaranteed cash deposits in the bottom bit. We're going to have some bonds in the low risk, well-rated bonds for some extra return. Then Paul's going to talk to us in a minute about these efficient equity funds where we're going to put the money. And then at the very top, we're going to be concentrating on direct real estate and real estate related investments. And our goal is to try and get a benchmark efficient return out of efficient assets as our floor, yeah? And we'll still have to have some cash available. So, and then what we want to do is as we find these inefficient assets, we want to use our cash and money in efficient equities and redeploy them into inefficient equities. So this profit stack will change a little bit over time as the money comes in and we place it in the market. Why don't we just from day one go and buy inefficient assets? Well, the answer is that the market's not always full of inefficient assets that you want to buy. There's a process to find them and do the due diligence and make sure that you have the skills in order to be able to tame the risk rather than just running out there and buying anything for any price. So while we find those inefficient opportunities and aim for those higher returns, we still want to be getting that efficient return from the efficient market. So we're no worse off being in this fund than perhaps direct investing for ourselves. In fact, for reasons Paul will share with you in a second, we think that the opportunities that we'll have access to in that efficient equity space are the sorts of opportunities that retail investors like you probably won't have opportunity in and of yourself, because when you're a fund with more capital behind you, you get a key to the door and in invitations to certain investment opportunities that you don't get as just a mum and dad investor with your money out there looking to place it in the retail world. So speaking of efficient opportunities, we're going to try and do a little shimmy over to Paul. I'm going to make Paul the presenter and he's going to take over. Let's see if this works.
Bit of history about Steve and I. As Steve mentioned, he started life as an accountant, and that's where I first met Steve at Boyd Partners some 32 years ago it is, Steve. As I was saying, Steve and I met at Boyd Partners some 32 years ago. We were both undergraduate accountants and we were working in an organisation that was on St Kilda Road. It wasn't a large organisation, but it packed a bit of a punch for what it was able to do in business services. In 1993, I'd left Boyd Partners and continued my final year at RMIT, where Steve was also doing his final year at RMIT. So we completed our undergraduate degree in business together. We spent some late nights doing some take-home exams and all-night sessions where we consumed copious amounts of Coca-Cola and chocolate to get assignments done. We then moved on to do chartered together. Steve was finishing his chartered, I was starting mine, and we completed that in the mid-90s. And as Steve mentioned, I'm just trying to think now. In about 2012, Steve approached me regarding an opportunity that he saw to set up a managed fund. And so, in 2012, Steve and I had spent some time scoping out what that might look like. And I introduced Steve to a gentleman called Keith Woodhead. And between Keith, Steve and I, we were the initial directors of PCL and have been there since 2012 together. From my own perspective, I worked in business services at a place called Gina Limited, and that was for 20 years as a chartered accountant, initially doing business services work. In 1998, the board decided that they wanted to set up a family office, and a family office was about integrating business services, investment opportunities, superannuation, lending, and bringing all those services together for a client, which also involved a wealth management arm. So we set up our own funds management. We set up our own internal private equity fund. We also managed investments on behalf of clients. We managed in excess of $500 million in clients' funds during that time. In 2012, Shadforth came along and looked at our model and said, look, we really, really admire what you've been able to achieve in integrating accounting, taxation, wealth management. We'd like to buy you. We'd like to roll your solution out amongst our clients. They had probably $13 billion under management that they were managing, and wanted us to roll out our model across their high net worth clients. That was short-lived, because what was intended when we first joined wasn't what eventuated, and so within 12 months I'd made a decision to leave Shadforth, which involved significant handcuffs. So I wasn't able to participate in the industry for another 5 years. Once I came out of those handcuffs, I joined up a group called Auslink Property, where I'm a responsible manager. I'm also on the compliance committee of the Auslink Property Fund. It manages in excess of $600 million as well. And as I mentioned earlier, Keith, Steve and I have been together in the Plantation Capital Fund since 2012. I haven't missed a trip to the US except for 1 year, which was when COVID hit. So Steve and I were over there in 2020, just at the start of COVID. We weren't sure if we were doing the right thing being there, but we still went, made some great decisions about the future direction of the fund, but unfortunately weren't able to go back there in 2021. But that's the only year that we've missed a trip over there. And Steve's sounding board, it's interesting, today I was going to be his water board after we'd finished a gym session, but it's been great just to be able to spend 30 plus years bouncing off Steve and bouncing off ideas. So it's been quite a journey. As Steve said, if the efficient opportunities, there's more than, we know that markets work. We know that over time it's really hard to outperform markets. And as an investor, we can access ETFs, exchange traded funds, or we can access index funds to to access those market returns. What we want to do is more than just access ETFs and index funds, because we understand that one of the biggest costs or one of the biggest detriments to returns, for example, is taxation. And so we know that if we have a focus on taxation rather than just matching an index, so that when an index fund invests, it has to match that index 99.999% of the time. And so there might be a fund or a company that you own, and it may be paying a dividend in a day or two, and if it slips in or out of the index, you have to follow that. Whereas if you had some flexibility, you could actually say, well, hang on, rather than selling that right now, can I wait 2 days to pick up a taxation, the dividend? Or could I wait? We might have owned it for nearly a year, and if we can hold off a day or two, we might pick up a 50% discount on the capital gains tax. And so our intention is not trying to beat the market, but we also understand that there are opportunities if we can match the market to 95, 96% of the time, which gives us flexibility to take advantage of these other opportunities that can present. So yes, people can access the market through ETFs and index funds, but there is a slightly better way with a little bit more flexibility that can give you some better returns. The other thing that's really important when we work with our clients, we always try to focus on building wealth intelligently. And so the intelligence around building wealth is around the portfolio construction and also around the asset allocation. And so we want to make sure that our asset allocation isn't too overweight in Australia. It will have a good allocation towards international funds, but it also have a strong focus towards after-tax returns and dividend imputations. We want to make sure that we are systematized, as Steve said. We want to have systems that work. So we want to regularly rebalance portfolios and review them. We want to be disciplined around the decisions that we make. We also want to be patient, and it's really interesting. I was just talking to Steve earlier, and you'll see it in my next slide. In the inefficient opportunities, you need to be disciplined and you need to be patient. And when we think about property investing, we take a long-term view towards property investing, and that's a discipline in itself by taking such a view. And being patient is also one of the ingredients for success. Yet when we talk about efficient assets, and it's news every night on the news about what markets are doing and what banks are doing, it's hard to stay disciplined, and it's hard to stay patient when you're bombarded with so many opinions and perspectives. Whereas when we look at property, we don't get caught up in so much news, and so just by its nature we are disciplined and patient. And I think that's really important. What you bring to the efficient opportunities is you need to bring that portfolio allocation, you need to bring systems and rebalancing, but you also need to be disciplined and patient when so much noise is occurring that can cause emotional unrest, but you need to move through that and be disciplined and patient, especially in that inefficient space. When we look at the inefficient opportunities, what we're looking to primarily identify are the direct property opportunities, and that's obviously Steve's skill set with all those decades of investing behind him. We'd also look at opportunities if there were property-backed mortgage lending, so that if we could see an opportunity that we could increase our return relative to our risk, if we could obtain a mortgage that's at a suitable LVR relative to the asset value, then that's something that we would look at. And we would focus on an income element initially, because it's really important. If we're trying to achieve a return of X amount and we can achieve 3/4 of that just through the income alone and the rent alone from a property, it doesn't mean we have to be chasing huge capital growth, especially when so much can be achieved if we focus on getting the income and the rents right. So our focus will be on a mix of in-place income, but also some growth opportunities where, as Steve mentioned earlier, where if we can identify problems and find solutions, then we can profit on income and on growth on those opportunities. Thanks. I think I might have one in between there. Sorry, Steve. I thought I had one more slide, but that's fine.
You're cooked. So, Harps, one of the things that I mentioned before was along the lines of opportunities that wouldn't be available necessarily to retail investors. What can you share in that space?
Well, there's a fund manager. So when we first started in doing wealth management, there were so many opportunities and so many fund managers that wanted you to, to come look at their systems and their processes and how they were investing. And then we actually went through two crashes. We started our wealth management in 98 and we went through the tech crash of 2000, then we went through the GFC of 2007. And so in the space of 8 years, there were two different crashes. And so it became a bit discerning as to all these investments that you learned so much about investment opportunities. But there was one organisation that throughout the crash of 2007 still stood tall. It wasn't saying that they didn't lose money, but their systems and their processes really stood up. And so we took a lot from that organisation and formed quite a tight connection with them. They were a US-based organisation, and so we've been, we'd supported them throughout, the decade that followed, and so those opportunities are still available, and those connections are still available to us now, for us to access on behalf of investors, and to actually access those, it's really difficult to actually access those funds. You can't just come off the street and say, well, look, I'd like to have my portfolio invested there. You would normally have to go via an accredited financial advisor, or you'd have to be at a scale where you could have a key to the door to go and meet with these people. So that's an opportunity that we can access that you can't just access off the street, and depending on the size of the funds that we're able to raise, that also they can even customize even more to our liking as to the different allocations that we would prefer.
So thanks, Paul, for walking us through what you just did then. What I'm going to do is just pick up the story here. Hopefully you guys can see that with a blurred picture. Why am I showing you a blurred picture? I'm like that ad on TV where here is a dentist, but because he's a dentist, we can't show you his face. So I'm showing you a picture of the deal and I've blurred it out so you don't know what it looks like in case you can identify where it is, because this particular deal isn't under contract yet and I would hate to lose it for the fund because I think it's going to be a good first inefficient asset. But I wanted to talk you through it. So the details of this deal is it's a commercial property. It's a mix of warehouse and showroom. And the rent is $200,000 per annum. And the purchase price is $2 million. So who has the superpower to be able to calculate the in-place return? Anyone? Sharon, fastest finger wins, 10%. And the tenant pays all the outgoings. So that's a gross and net 10% return. There is a 9-year lease that has just been signed, and it's in a very high vis location. So location's good. The tenant is a AAA tenant, credit tenant, 9-year lease, 10% return. Who else would like to own an asset like this? I mean, it's not a purchase price this is a pretty entry-level commercial property for commercial real estate in Australia. Yeah, right. So it's looking pretty good. So why is this an inefficient asset? Like 10% return. Earlier on, Steve-O, you said that risk and return are related. How on earth is this thing priced at 10? Well, first thing you need to know is that it's not in the middle of Melbourne. It's a regional asset. And then even though it says it's a 9-year lease, it's a 3-year lease with 2 3-year options. And after asking 3 or 4 pointed questions, it turns out that the tenant isn't actually going to stay beyond the first 3-year period. So it's not a 9-year lease, it's a 3-year lease, and they're going to be gone, which means that the site's going to be vacant in 3 years' time. How easy is it going to be to find another tenant? And what's the risk that $200,000 rent, because it's a sale and lease back, might be inflated to justify a higher sale price when the real market rent might be 150 or 160, or I don't know. I haven't got it under contract yet, so I haven't started doing the due diligence yet. So here's a good example of a deal that if you were just focused on return and nothing else, you might jump in and buy it. But as that old ad used to say, it's the fish that John West reject that makes John West the best. And it's the deals that you don't buy in due diligence are the deals that you probably didn't want to buy if you had been impulsive, or as I started off this webinar earlier on, the deals you jumped into without actually asking the hard questions that you should have. So are you seeking out of an opportunity, not only return, because return, let's be honest, is important, but are you also looking for the experts to be able to find and filter the mines of opportunity, or the mines and those strategic opportunities that we're talking about? And also have those experts manage and mitigate to dial down the risk so that we can get the return without having to worry about the risk quite so much, because it's the work we've done before we've bought that sets us up for less bumps after we've bought. And then all you need to do is just sit back and say the experts are at work, they're finding the deals, they're filtering the deals, they're financing the deals, and then they're returning the profits as finance to me by regular distributions. I mean, that's a pretty attractive opportunity, and that's what people in the US fund have had the better part of it, pardon me, a decade of benefiting from. So that's what I want as an investor. I want these opportunities for myself, let alone for you. I want to be able to find these great deals, and I want to be able to profit from them. And as I'll share in a second, a large motivation of being involved with this new fund and setting it up is so that I can continue to do that on a scale which is far in excess of what I can afford in my own right. So, can I tell you about this fund that we've set up? Would that be okay? Would you like to know a little bit more? Hopefully the answer is yes, because that's what I'm about to do for the next half hour or so. Now, I want you to imagine you're standing at a door and the door's unlocked. You need to open the door and walk through. Well, the door that you have to open and walk through into this opportunity is there's two things you need to do to walk through the door. The first is to read what's called the target market determination. And the target market determination is a document that we wrote to try and help people to understand whether or not this is an investment that might be suitable for them. We can't give specific advice on everyone's situation, but using some guidelines that ASIC suggests that you use, we've gone in and created this document, and using a green, amber, or red color system, asked some questions and then said, where do you fit within the answers to these questions? And if you're in the green, then you're part of the target market. If you're in the amber, you might be or you mightn't be. And if you're in the red, well, then this product isn't going to float your boat for you. So you can do your own self-assessment pursuant to the target market determination. And then, of course, the legal document that we're accountable to is the product disclosure statement. And you need to read the PDS or product disclosure statement because that tells you absolutely everything you need to know about this investment opportunity. From a legal perspective, it's not written like a best-selling book, but it's not allowed to be written like a best-selling book. It's got to list out all the risks and it's got to have certain legal language in it to comply with the corporations law. So between those two documents, that is the doorway that you open to walk through. And what's on the other side? What's on the other side really is the answers to all the questions that you might have about how does this actually work? And so what I want to do right now is spend a bit of time trying to answer the common questions that people have asked us. And all these are all outlined in the product disclosure statement, but just to bring them to front of mind, let's go through them. The first question you may be wondering is, Steve, aren't you financially free? And if you are, why on earth would you start another fund at age 51? Don't you want to go and sit at Bindi and watch the trees grow, or go traveling around the world with Jules, or go and do something else and just enjoy your money? And the short answer is absolutely. After running the fund for 10 years, the US fund, I don't want to do another US fund. I have spent the last 10 years of my life really with a full-time job in the US fund. And what I want to move away from is that into more of an executive and position responsible for the inefficient direct property assets, but I don't want the day-to-day compliance and the day-to-day reporting and all of that kind of thing. I'm ready to leave that behind and say, well, I've enjoyed it in my life, but I'm ready to stop doing that so I can start doing other things. So the reason why I started another fund is really threefold. The first reason is selfish. Frankly, I need to deploy my money for a return, and I see that the systems and the processes involved with this fund and the discipline that has to come in order to meet the legal requirements as providing a level of sophistication and discipline, dedication that I probably wouldn't bring to my own investing if I didn't have to. So it forces me to be the best that I can possibly be by having to comply with the system. So I would love to be involved in a managed fund. I don't want to be a part of someone else's managed fund that I am remote to. I want to be involved very close to the center so that I can use my skills and expertise to find and filter those deals and to fund them, to be able to profit from them. The second reason is that, yeah, I do want to open up this opportunity for other people because I know heaps of other people are too busy, or they can't stomach the risk, or they don't have the skill, or the number of people who've told me, Steve, your US fund was the best investment we've ever had. We've had investments in other things and they've gone bad, but over the course of time, this investment has remained faithful. And the reason for that is the structure that sits around and in the investment that holds it up. And so I want to make this opportunity available for myself, and I want to make it available for other people as well, particularly those people who want to be involved but don't want to have to run it. And then I've got altruistic reasons for running this fund because my share of the management fees that come from this, I fund into legacy projects, into philanthropic projects that benefit other people and add meaning and significance into my life. And the more money that comes in, the more money I can distribute out, the larger the reach that I've got. And I love the idea of a win-win outcome, that I can be involved in something that helps other people make money while it makes money for me as an investment, brings in some management fees that I can then use to bless other people with. So how does the fund work? Well, I've got a little diagram for you that hopefully you can see on the screen. Let me just go to here. Yeah, it might be a little bit small, but sitting up the very top of the diagram and central to everything we do are the investors in the fund. And you put in your subscription money or your initial amounts into an application account. And then when we allot units when we match your application to your investment sum, check your ID's okay, and give you units which start off at $1 each, we then move the money out of the apps account into the ops account. And you've got a bit of paper that says, I own X number of units. And then once the money's in the operations account, it's ready to be deployed. How will it be deployed? Well, first of all, we'll take it out of the lower interest operating account and start trying to find slightly higher interest earning deposits, which are risk rated. So relative to the risk we want to take, probably not great with that cash amount of money. We then move it out of that cash with that slightly higher interest rate into the efficient assets and then into the inefficient assets as and when we find them. Now those cash and money market deposits will return interest. The efficient assets will be dividends and distributions, and the inefficient assets will be rent and capital gains. And all of that flows back into the operations account. And then because the fund is a trust, we have to distribute the trust income back to the investors as distributions, and then we use the cash that's in the operating account to also fund redemptions in time. So this isn't a question of, oh, we're not like a company where we can choose to pay a dividend or not pay a dividend. As a trust, there's no benefit in hanging on to trust income because it gets taxed at the highest rate. So we are forced to distribute the money back to you as we have been in the US fund for the past decade for those involved in it. So this is quite a nice model that allows us to have the flexibility to invest in the assets we want to invest in while also being compelled to offer distributions back to investors rather than, say, a company like XYZ Proprietary Limited or XYZ Limited, which says, no, we're going to hang on to our cash, so that means less for you. And because we're an income fund primarily with growth upside, we really want to be providing that income back to investors. Hopefully that makes sense. So how on earth are investors going to profit from being involved with this Strategic Opportunities Fund? Well, two ways. Growth, because we're calling it Strategic Opportunities Growth and Income Fund. So as the value of the assets that we buy go up, the value of the units goes up. And then obviously income. As we get interest and rent and distributions and dividends, as that money piles in, so it must also be distributed out. Who can invest in this fund? Is it only certain people? Well, the good news about this fund is that it is a retail fund. So that means that the amount of work we had to do to get it as a retail fund was substantially more than being a wholesale fund. Is a wholesale fund different? No, it just means that you have to be a sophisticated investor to invest in a wholesale fund. But anyone can invest in a retail fund. And that's why this opportunity is possibly good, not only for you, but if you wanted to be like me and get my kids involved and say, right, you need to learn the discipline of investing. You need to get involved in this. And not only do you need to just put your money in it and set and forget it, but you've got to use this experience to learn about how to become a better investor. So who can invest? It's a retail fund, so it's open to everyone. That doesn't mean that everyone's right for the investment. You've got to do the target market and read the PDS, but the fund is open to you as an individual investor or joint investors, and it's even open to you if you wanted to open an account on behalf of a child. It's open to self-managed super funds, which are called regulated trusts. Whether or not your trustees are individuals or a company, it doesn't matter. And if you've got a family trust or a unit trust, you also can invest. You're called an unregulated trust. And then if you've got a company in its own right, that can also invest, whether it's a private company, a PTO Ltd, or a public company. Now, we can also take applications from associations and other managed funds and sort of more complicated, but this is our wheelhouse. Investors like me, individuals, self-managed super funds, family trusts, unit trusts, and companies, if you'd like to invest in a company structure, is all okay. What's the minimum investment? So we ummed and ahed about what would make the minimum investment with this fund, and we were going to make it 50 grand, and then we said, what about 25 grand? Pardon me. But in the end, we were like, I know the admin's more, but it opens the opportunity to more people. So the minimum initial investment at the time of opening your account is only $10,000. And then if you want to do a top up, then the minimum top up amount is $1,000. Now I would say the same thing now as what I did at the start of the US fund, which is if you've only got $10,000, then that's all you've got, right? But if you've got more money, I'm not giving you advice here, but like, let's say you've got $1 million to invest. And you're like, I'll put $10,000 in and see how it goes. If it goes smashingly well and you double your money, right? You've made 10 grand. That's not going to be a life-changing sum of money. So you've got to put it in the context of what is your expectation? And your expectation is how much risk you want to take, how much effort you want to put in, how much time you want to invest for, and how much aggravation you want to tolerate as part of the investment. But by making the bar quite low to enter at only $10,000, our hope is that more people will be able to be a part of this. And even if they can't invest a lot at the start, that over time they build up their investment by topping it up or participating in the AIP, which we'll get to in a second. Get to it right now. We've also, unlike the US fund, created the opportunity for investors, and we'll launch this in November, to authorize us to direct debit an amount straight out of their nominated bank account towards the application of new units. And the minimum is $250 a month. And I've already had a couple of investors say, look, we've got our account set up. How do we do this AIP? Please just be patient. We're so focused on getting people set up that we haven't got the bandwidth right now to get people signed up on the AIP. But come November, we think we will. How much will you be investing, Steve? Well, that's a fair enough question, bearing in mind what I just said. My initial stake will be over $5 million, which will make me by far and away the biggest investor in the fund. Now, why would I do that? Well, I've given you the answer already, right? I want the structure of this fund and the discipline of this fund to force me to be more diligent with my investing than I might otherwise be as a slacker without that infrastructure and scaffolding around me. So both my kids have also invested, and I plan to roll in the money that is invested in the US fund and hasn't come back yet through additional top-up investments. Now, Paul is also going to invest. His own situation is that he has to refinance a big investment that he's got, but he has committed to doing that and putting a seven-figure sum in, he's told me. It may not just be in there at the very start. So let you know, and I think it's important that both Paul and I will have skin in the game with this investment. Paul's last name is Harper. What kind of returns are you targeting? You know, it'd be nice to say, oh, we're going to shoot for the sky and get a insert massive return here. But we're more realistic than that. We would rather under-promise and over-deliver than over-promise and under-deliver. And while past performance is not an indicator of future performance, and we're not making any earnings estimate here, the truth of the matter is that the US fund went well and above what I thought it would do. And I'm hopeful that this fund will do better than we hope it'll do, but only time will tell. So what I'm about to show you here are estimates. They're not guarantees, and you need to read them as much as X% rather than at least X%. They are both growth and income returns, but before tax and fees. So when we look at the low risk part of the profit stack and we're looking at cash, we're looking at the RBA rate plus 1%, possibly between 1 and 2%. In the bonds, and we're not going for junk bonds or anything like that, we're looking at the RBA rate, which is presently sitting around 4%, plus 3% on top of that, 300 basis points. In the efficient market, the sorts of things that we've done modeling on, the long-term returns, so smoothing out for volatility, sit at about 8% per annum each year. So that means that every 12 years, those assets double in value. And then in the inefficient space, we're looking at the 10% return mark, which is still quite high, bearing in mind that a lot of commercial property in Australia is sitting at the 6 to 7% rate. But because we'll be an all cash buyer, we'll refinance later, because we have a reasonably flexible investment gambit of what we're trying to buy, and because I'm pretty nimble at being able to get out there and buy, we're hopeful that with the network that I've got around Australia, and when we say, right, we've got a war chest, that we'll be able to go out there and place the money pretty quickly. For instance, I've got a $16 million deal that's come across my desk that I'm negotiating. They want, they're trying to get a 6.5, but I might be able to get this brand new asset, so it'll have depreciation benefits, and so it'll be tax deferred, and it'll be a tax attractive investment, trying to get it at an 8% out of the gate. Now, 8% is not 10%, but when you factor in the tax deferred, the 8 becomes the 10, if you follow my meaning. So what is the minimum subscription? Okay, glad you asked. So when Paul and I sat down and devised this fund together, we said that if we can't raise 30 million, it's probably not worth going ahead, because the fixed costs associated with running a fund, having to get an audit, the legal fees, the ASIC fees, etc., it means that all the profits get eaten in fees, and it's not attractive. So 30 million was our benchmark. If we can't raise 30, don't worry about it. And we gave ourselves until the 30th of December 2023 to raise that money. Now, if we don't achieve the 30 million, and there's not much benefit in talking about this because we're about to achieve the 30 million, but if we don't achieve the 30 million, the units will be redeemed, the capital will be returned to investors, the interest will be distributed back to investors while it's been sitting in the apps and the ops account, and all the setup costs will be paid by Paul and me. We'll absorb them in the RE, so you won't be $1 out of pocket. But when we achieve the minimum subscription, the unit price goes from a fixed dollar per unit to a floating price based on net tangible assets and issued units. And then those setup costs that have been paid by us to get the fund up and running will be passed back to the fund to reimburse us. And that sits at about $200,000 to set up the fund, which sounds like a lot of money, but over 30 million isn't much in the grand scheme of things. Now, what happens if we achieve the minimum subscription before the 30th of December? Well, because we're launching the fund tonight, and we realize that it might take a little bit of time for people to get their information and acts together, then even if the minimum sub is reached tomorrow, we're going to keep it open until the 30th of September. So that's a little bit over 2 weeks, which should be enough time for people to be able to get organized. And then what that means is we'll also start deploying the money the second we get over the minimum subscription. The other thing you need to know is that the first amount of capital that we're trying to raise is 75 million units. Once we get to 75 million issued units, we're actually going to close off the fund temporarily until we've placed that money and stabilized the fund, and then we'll open again to the second offering. Yep, but if you want to get in when the unit price is $1 at the first offering, which I think will be the best deal, then you'll want to get going pretty quick. Rightio, Steve, what's the contribution fee? I'm glad you asked. So the contribution fee is your cost of admission into this investment. So Paul and I have spent the last 9 months of our lives pretty much 40 hours a week plus putting this investment together for you. And the contribution fee shouldn't be seen as a negative thing. More so, it's like the cost of going to the movie. Someone's gone to the effort of putting the movie together and you're just paying to enjoy the movie. Well, you're paying us for the work we've done in making this available for you. And that's fine. Remember, if you pay peanuts, you get monkeys. And as I like to say, I'm no monkey's uncle, right? So what is the contribution fee that you're going to pay. I should say you pay the contribution fee every time you make an investment. Yeah? So the contribution fee that you pay, in my opinion, isn't a lot of money. It's $2 per $100 you invest, or 2% plus GST. You invest $10,000, we're talking about $200. Yes, you invest $1 million, we're talking about $20,000. So it scales on every dollar. But at the end of the day, we're talking about 2 cents in every dollar, or what are we talking about? $2 in every $100. However, if you get in before the minimum subscription is achieved, you'll be able to benefit from a 50% discount. So instead of paying 2% plus GST, you'll only pay 1% plus GST. As a little incentive to say, if you get in early, we want to say thank you. Thanks for helping us meet that minimum sub ASAP. We'll discount the contribution fee for you. Just remember, this discounted contribution fee, right, is only until the 30th of September, which is 2 weeks away, or the 30 million sub is reached, the latter of. So it's definitely open until the 30th of September. But if we reach the minimum sub before the 30th of September, then come the 1st of October, we are live and running, and then the contribution fee will go back up again. So where are we in the capital raise? Well, by the grace of God, as of this afternoon, we are 68% of the way towards achieving our minimum subscription. But Steve, you're only launching the fund tonight. How on earth are you 68% of the way already, and we're only at the 12th of September? Well, what we did is we did a soft launch, and we only wanted a small number of people to help us with a soft launch, but the word got out, and people have been literally piling in to be a part of the discounted contribution fee. Now, the other thing I need to tell you is, remember how I said I was investing 5 million before? Only 2 million of that 5 million is in these numbers. I've got a $3 million more of just my own money, which I hope will finally be released and ready to invest tomorrow. So that'll push us into 23 million raised and only 6 and a bit million to go the second that lands. So what does that mean? It looks like that it will pay to act. If you apply now, you're guaranteed to get that 50% discount and only pay 1% contribution fee plus GST. But if you muck around, if you leave it too long and the money comes in as I expect it will before the end of September, then that's not a problem either, right? You just pay 2% contribution fee, which is what you should have been paying anyway. So don't feel like that's necessarily a bad thing. But if you can get your stuff together and get your application in, then you'll get a small benefit by doing so. Now, the 30th of September happens to be a Saturday, which means that we must have received your application and your investment sum before, really you want to do it on the 29th, right? And in fact, you want to do it even a little bit earlier than that in case there's something wrong with your application. Now, here's what we've agreed to do. So long as your application has been received and your investment money has been received, even if we haven't got around to processing your application, then because you've given us the application and the money, even if we get around to it in sort of the start of October, we'll still apply the discounted contribution fee for you because you got in before the end of the month. All right, because I'm just anticipating my team might be smashed a bit to get through all the applications that are going to come in. If the 29th is a public holiday in where you live, then just be aware of that and bring it forward again, as the case may be. So, all right, Steve, you keep talking about the expert team. What's your management fee for offering this investment? Well, for a full outline of all the fees associated with the Strategic Opportunities Fund, please read the product disclosure statement, section 8. I'm only going to cherry pick the fees right now. The first thing about the management fee is the expenses that we incur to run a fund, like the legal fees and the ASIC fees and the audit fees, they're just passed through, right? You're not paying us a fee for doing that. We're not adding an extra 10% no, we just pass them through dollar for dollar for the expenses that are incurred. And then remember before how I said about this is a fund for investors, by investors, and with investors? Well, we're not charging any management fee. What? You're not charging a management fee? No, this is a point of differentiation between this fund and other funds. We're not going to sit there and get paid for churn. We want to say we're only going to get paid if we perform, and our performance is linked to return. If we don't perform, then we don't think we should get paid. If we can't do what we think we can do, then why pay us, right? We're willing to underwrite our own performance through our fees. Now, like I said, it's not very common that you're going to get someone that's just going to take no management fee, because then we've got the costs of running the fund, and if we can't perform, then that means it's money out of our pocket. So very few people are willing to take on that level of accountability that I've seen. What about the performance fee? Yeah, well, we're not going to charge a management fee, but we're going to take a performance fee. And we've got a baseline performance fee, and then we've got a if we shoot the lights out performance fee. So our baseline performance fee is 1/10 of the return that we're able to give investors plus GST. Or for the first 10% of fund performance, 10% of that comes to us, 90% of that goes to investors. Do you agree that's fair? I actually think it's a really good deal, considering that we're not taking any management fee and we're just 1/10 for the manager and 9/10 for the investor. I reckon that sounds like a good deal. But hopefully you agree, because no one has agreed with me. Damn it, Steve, we want you to work for nothing. All right, good. A few people are jumping in now and saying that's a good deal. Thank you for those people who are still awake. All right, what about thereafter? What about if we shoot the lights out and get like a 15% return? Well, anything above 10%, we now get 2/10 off. So if we get a 15% return, we take 10% of the first 10 and we take 20% of the next 5. Yeah, because we're incentivizing ourselves to go over and above in order to get that return. Now, what about if the return's negative? We don't get paid. So there's a counterbalance to us running out there and trying to get return at all costs, because if we get it wrong, then all of a sudden we're funding all the operating costs of Plantation Capital Limited out of our own pocket. The fund still has to pay for itself, but for us managing the fund, we don't get paid for that, and we've got employee costs and our admin costs, etc. And then as managers, we don't get paid for the time that we put in. So there's a nice little counter check in this by saying if you get negative performance, you don't get paid. And then what some funds do, which we're not doing, is some funds will say even if we lose money, if we lose less than the benchmark, then we've still performed. I think that's doublespeak. If you don't get a positive return, you don't get paid in my world. So all I'm doing with this fund is creating a fee structure which I hope will become the industry benchmark for all managed funds, which I think is more than fair for investors. All right, what's the acquisition and disposal fee? Yep, so the amount of work that goes into finding assets and doing the due diligence on them and negotiating not only the purchase but also the sale is significant. And remember, you don't always get paid for the assets you don't buy, right? The John West theory. So the performance fee is managing the assets after they're bought. For the time and effort that goes into finding the assets and the time and effort that goes into selling the assets, we're going to pay ourselves a fee of up to, so not always necessarily full whack, but up to 2% of the sale and purchase price of only the inefficient assets and only the direct property in the inefficient asset space. The efficient assets, the cash and deposits, no fee associated with buying and selling them. Only the inefficient assets. All right, Steve, you told us you aren't going to do what you said you were going to do with the US fund. What will you be doing with the Strategic Opportunities Fund? Well, I give you this undertaking that I'll remain as a key executive with this fund. And not only that, while I transition to a non-operational role, I'm still involved in the operations, just a little less and less as time goes on. I anticipate for the next 6 months at least, probably 12 months, it's still going to be a full-time job for me as we wind down the US fund and wind up the Strategic Opportunities Fund. And then as I step back from the operations, Paul is going to step in. So there's a mentoring / guiding role that I've got for Paul as he builds the muscle up, and as I then say, right, I can now take more of a back seat role than a front seat role. But I expect to remain fully responsible for the direct property inefficient asset purchases, which means finding the deals, doing the due diligence on the deals, and then bringing them to the point where they've bought and stabilized into the management structure. I just won't be doing the hands-on day-to-day management of the properties after they're bought. We'll have the systems and processes in place to be able to do that, and Paul will oversee it. Of course, if anything goes wrong at any stage of the process, I'm there to jump in, and because I'm the biggest investor in the fund, obviously I'm going to be watching this pretty closely at an executive level without micromanaging everything. Will you offer a distribution reinvestment plan? Yes, we do. And if you participate in the DRP, then by reinvesting your distributions, we'll give you an up to 5% discount off the issue price at that time. Just by saying, well, you've kept the money in the fund, it means we can retain more of our working capital. So yeah, you deserve a bit of a bonus for doing so. The DRP at the moment is all in or all out, so 100% reinvested or 0% reinvested. And you can choose to participate during the application process, or you can change your mind one way or another later on as well. What's the automatic investment program? So I mentioned it briefly before. The AIP is an authority you give us to direct debit from your nominated banking account an amount every month and use that money towards buying more units in the fund. It is subject to the contribution fee. The distribution reinvestment plan has no contribution fee on those units that are issued, but the AIP does. Why? Because otherwise people would put a small amount in and load up the AIP later on. So we're just making sure people don't game the system. So the AIP, and I have told my kids this would be really important for them to have a think about, takes the forethought of having to top up, and it's sort of like a forced savings program where your money is not only earning an income return or going to plan, it will also earn a growth return. So it stops you from spending that money, you lock it away into your investment vehicle where it can sit and compound behind the scenes. The minimum amount is only $250 a month, works out to be about what, $60 a week. And then that is direct debited, as I mentioned, from your nominated bank account. How do you participate in the AIP? Just hold your horses, doesn't begin until the 1st of November. There's a form you need to complete. Unfortunately, it's not part of the online system yet. It sort of exists offline because it's not part of the unit registry that we've got online, but that's some work we'll need to do to try and figure out how we automate this. We actually haven't yet built the system behind the AIP. We've got the authority about a week ago from the CBA in order to do it. Now we need to build the systems behind it. But as an investor, once you become an investor in SOGIF, the details will be emailed to you. What about redemptions? What about if we want to get our money back? Well, the first redemption, there's a lock-in period, a short lock-in period until the end of 2024, so about 18 months. And thereafter, we plan on offering 2 redemption opportunities each year, about 6 months apart. So with the US fund, we only did 1. With this fund, because we anticipate it'll be more liquid with the efficient assets, we'll be able to offer 2. Now, as in any redemption, if the amount of redemption requests is greater than the amount of money we set aside for redemptions, then we scale it back. If it's not, then everyone just gets paid out in full. How do we apply, Steve? All this sounds fantastic. Well, I'm glad you asked, because everything you need to know about how to apply and even to complete the application progress is available at the fund's website, which is, say it with me, www.sogif.au, S-O-G-I-F.au. There's no com, just www.sogif.au. How do you remit the initial amount? Now, when it comes to your initial amount, what's important to know is that the initial amount is not how much you hope to invest now and into the future. It's just the amount that you're going to send us with your application. Remembering the minimum initial amount is $10,000. So most people are sending the money in electronically via electronic funds transfer. Couple of people are sending them in by check. If you send them in by check, they probably sit in the office for a couple of days till we can get to the bank. So I know some people get a bit antsy about EFTing the money, but if you send it by check, it'll still come to us. It just be a bit slower to process your application. And the details for how to fill in the check or where to send the money to are included in the product disclosure statement. So that brings us back to this slide. I've outlined the opportunity that is available to you tonight. And I wonder who would say they wished they had have got, if we could get back in the time machine and go back to 2012 when the US fund was being launched, who wishes they had have said, or oh, I wish I had have either invested or invested more back at that point in time. If you feel that, just say me into the box now and hit return. If you wish you had have invested more, or you even had have invested had you have known about it at that time, yeah? So now we've got to learn from that. And we've got to say, all right, well, you know, what do I want from this investment? What caused me to miss out last time? And how will I not miss the boat again this time? Once again, you need to make an informed decision by reading the TMD and the product disclosure statement. But I'm going to make the same offer that I made 10 years ago, 11 years ago. All you need to say is, Steve, take me to the mine and join on up and then come into the mine with me. I'm there looking for the opportunities, putting them into the cart, bringing them out, taking them to market. And it's your opportunity, not for me to do it for you, but for me to do it with you. And that's what makes this all the more special, in my opinion. One thing I should say to everyone is keep an eye out for my new series of live one-day seminars that I am going to be running in October, where I'm going to spend a whole day with you in person. We've only spent like an hour tonight, but I want to really spend a whole day delving deep into the idea on how you can level up your investing and the work that you need to do pre-investing, at investing, and post-investing to really become a better, more sophisticated, capable investor. Now, these one-day seminars are going to be in Sydney, Brisbane, Adelaide, and Perth. Those of you in Adelaide and Perth probably saw an email from me if I know you live in South Australia or WA, which I emailed out today. Sydney and Brisbane and everyone else where I don't know where you live will get an email in the next day or so. So for being on the webinar and either watching the recording or being there with me live, I would love for you to come to the event as my guest for absolutely no cost. That includes me buying you a light lunch, which we'll serve at the event. All you need to do is input the coupon code SOGIF, S-O-G-I-F, in the cart on your way out, and that will reduce the price from $49 a ticket to the grand sum of $0. Please do not book tickets and then don't show up. That will be that will not be helpful in any way, shape, or form. So write down that code, SO for Orange, GIF, because you're not going to find it anywhere else. It's just a special little thank you for being part of the mix. If you've already booked, like Sean is saying, then just drop me an email, steve@PropertyInvesting.com, and I will get the team to refund what you've paid to come along. We are going to do a little bit of Q&A if anyone wants to ask any questions. Now, there's a lot of people here right now, hundreds of people, so I don't know that I'm going to be able to answer everyone's question, but we will do a little 20-minute Q&A session now, then we'll have a break for a couple of minutes, and then we'll come back and I'll show you behind the website how to fill in an application. So you've got a bit of confidence in being able to do that with me here with you. So let me go to the attendee screen. And the way this works is there's a little button where you can raise your hand. And I think I forget what color it is, but a little button where you can raise your hand. And then if you've got a web mic, then you're able to talk to me like over the radio. The trick though is that you'll be muted at your end. So you've got to click the unmute button in order for me to hear you when I say your name. Now remember, if you type in a question into the box, then Paul and Alina are going to try and answer your question for you as quickly as they possibly can. Or if no one's got their hand up, then I'll jump in and try and answer questions over. Now, green arrow means up, Mr. Colorblind, okay? So apparently, which means it's down, whatever. That's not real helpful, Newman, but I'm about to click it on my screen and see if anyone wants to ask any questions. So here we go. We've got a few people whose hands are up. So we're gonna start with Wayne Beddoe. Coming to you, Wayne. Remember to click off mute. There you are. Hi.
Hey, Steve.
Good evening.
Great, excellent. Hi, good evening. I'm just wondering, you mentioned a few times about the US trust that you did, and I'm wondering what sort of returns did you get if everyone's like, wish I've invested more?
That's a fair question. The reason I don't like saying the number is that it creates a bit of a expectation for this new fund of what we're going to do. But the answer to your question, remembering that past performance is not a guarantee of future performance, and this is an entirely different fund with a different risk structure, but we did over 16% per annum for 10 years in the US fund. And that was before, after fees,
Oh, wow.
and before the foreign tax offset that people got. So it was honestly a smashing return, and a return far in excess of what I thought would have been possible when we launched the fund.
Great, excellent. And one more really quick one. You mentioned about the 8 to 10% return on this one, as in just a rough guide. Now, is that 10% or 8 to 10% of income per year, and then on top of that, there would be the hopefully some capital growth as well, or this is total?
Combined growth and income return, yeah.
Okay, yep. Excellent.
Yeah,
Thank you,
and
Steve.
I know some people are like, oh, you know, wow, I don't know if 8% sounds a lot attractive, but you've got to understand, although interest rates have gone up a bit, asset prices haven't reset yet. And the benchmark for commercial property in Australia before interest rates went down to generational lows was sort of 10. And at the moment, commercial real estate is still priced in at between 6 and 7. So what gave us that extra return in the US was the foreign currency, because we got going when the Aussie dollar bought more than $1 US, and we won't have that same currency gain on this fund. And I mean, I just look at myself and I say, Steve, if I could get an 8% return on my money, and I didn't have to worry about the aggravation, and I didn't have to worry about the management, but it was in a structured fund with accountability, would I be happy with that? And my own answer is yes. Now, if people want to get a higher return, then what they need to do is go into the inefficient market, like I explained today with the profit stack, and they need to take on the extra risk with the extra aggravation and the extra skill to get it. But if you want a passive return, then you have to sacrifice some of the yield in order for the management of the investment for you. That's the way it works.
Gotcha, excellent. And I'm so sorry, everyone, but one more really quick one. As far as, and I missed the first 10 minutes, did you mention something about that you will also be educating us in regards to the purchases as we go along? So we'll be learning as you purchase.
Yeah, so what we do, and we don't force people to do it. It's not, if you don't want to do it, you don't want to do it. But if you're interested in taking more of a active view on understanding what we bought, why we bought it, even what we didn't buy and why we didn't buy it, then we run these webinars like tonight about at least twice a year, sometimes more frequently than that. And we usually try and meet up together at least once a year in person over a unit holder meeting or a dinner or that kind of thing, where we can all get together. So this is as much about relationship as it is return in this particular fund. Not that it's a cult or anything like that, but there's greater accountability and transparency with this fund than what you're likely to experience with any other fund that I've ever seen. And that's the DNA of the US fund coming across to this one.
Terrific. Thank you, Steve. Appreciate it.
Yeah, you're more than welcome. Thanks for asking the questions, Wayne. Joel, I'll come to you next. Good evening, Joel Teggett. You're off mute, mate, but I can't hear you at the moment. Play around with your settings until I can get to you. Keep talking. Drew Campy, coming to you.
Hello, Steve. How are you?
Got you, mate. Can hear you loud and clear. I'm well, thank you. How can I help you?
Steve, just wondering, certainly your American investment is the best I've been in. I'll just tell people that. But so if I send in a deposit of 10,000 or more, what happens if I say to you, just roll my the remaining of my US fund over into this new fund?
Yeah.
That's doable?
Yeah, so for US fund investors, I did an update on the weekend, and the video of that update is available at the PassiveIncomeFund.com website under the videos area. And
I did see it, but I haven't watched it yet.
Yeah,
Sorry.
if you watch it, the answer to your question is laid out point by point. So yes, you need to open an account in the same name as your US fund. Minimum amount needed to open it is 10. Once you've opened it up, you fill in a form called a draft, Distribution Reinvestment Authority form, and you nominate 25, 50, 75, or 100% of your US fund distribution you want us to automatically reinvest. And then once you've opened your account, put in your application form, send us the draft, then the next distribution we'll do in the US fund, which will probably be start of November, will go straight across to this.
Okay. Thank you, Steve.
All right, excellent. Click that, click that. Let's go to Linda. I'm going to come to you because I want to balance the boys and the girls. Hello, Linda. Linda Barron. Come off mute, Linda. Oh, wrong button. Self-muted. Did you accidentally put your hand up, Linda? Oh, might have been a bit early there. Let's come to John. Good evening, John. Oh, no. Felicia, I've just clicked you by mistake. Come off mute, Felicia, and you can have a chat. There you are. Hello.
Hi, Steve.
Good evening.
Yeah.
Nice to see you.
Good evening. Thank you. Just got a couple of questions. One was you mentioned that the US fund ran for about 10 plus years and you're sort of closing that now. So do you have a limit for this one or you're just letting it run?
No, we're going to let...
And the second...
Well, let me answer that question because I'm a guy. I can only do one thing at once. We're going to let the fund run this time round because some people have said as the US fund was wrapping up, we would have liked to have continued it. We understand you don't want to be a part of it anymore, but if we would have loved to have stayed involved, we actually don't want to jump out now. And so this time round, what I'm saying is I'm happy to be a part of it for as long as I'm a part of it. And then when I'm not a part of it anymore, what we'll do is we'll give people the opportunity to redeem. I'll be transparent about it. Hey folks, it's time for me to move on, retire, whatever that looks like. Here's what that looks like for me. And if you no longer want to invest in this fund, then we understand you'll have the opportunity to redeem, but here's what it looks like going forward. So there'll be full transparency and an opportunity for people to redeem if they don't want to be a part of it anymore. But I'm anticipating being a part of the fund for the long term. It's not like I only have a 1 or 2 year time frame here. I don't have any plans of not being associated with it for the foreseeable future.
Yep. And the next question was, is it just limited to Australian assets, or are you going to move beyond Australian?
In the inefficient space, it's not our intention at this time to buy international assets with the inefficient money. I mean, it's possible, but it would be regulatory difficult. But in the efficient space, then yes, in order to get balance across the efficient space. I mean, Australia is only a tiny market in the global scheme of things. So through a fund of funds approach, we're going to have some exposure to international securities as well, for sure.
Yep. Okay. Thanks.
All right. Thank you for asking those questions. Linda, are you there still? I think I can hear a Linda. Nope. Nope. Maybe Linda doesn't know that she was on. So I'll pop Linda's hand down. Let's go to Ian. You're next, Ian. Over to you.
Hello, Steve.
Good evening.
I just had I was having a look at the website and application, and my entity is it's a trust, family trust. So it's an unregulated trust, but it's got a trustee. The trustee is a company.
Yep.
And so I was going down, I wasn't sure. I was trying to see, do I need to put the ACN or for the trustee company? And obviously there's the ABN as well for the trust. So I was just getting a little bit confused about what I should be providing.
So in the system,
in terms of identification.
Yeah. So in the system, if you're doing an online application and you nominate that you have a trustee company, there'll be two parts to your application. There'll be for the trustee company and there'll be for the trust, right? And so you go into each separate part and complete the data that you need to put in for both.
Okay. So I just got to do two separate things.
Yeah. It'll open up for you, and you don't do it all in one section. You do a bit for the trustee company and a bit for the trust. But if you get stuck, just drop admin@sogif.au an email, and we can always try and troubleshoot it with you.
Yeah, no, I did my individual verification with, I was just going through the trustee company and the trust.
Yep.
Yeah, so I was just, awesome. Thank you.
All right, keep going. Well done.
Thanks.
Sharon.
Hi, Steve. Hi, everybody. First, Steve, thanks very much for the opportunity to be able to invest in this fund. It's great coming off the back of the US fund to be able to have somewhere else to deploy our money to, which is great. And also to you and your team that have been really helpful in the application process that I've been through has been great as well. Quick question though, if you found some extra money under the couch and you've already put your application in, and you want to top up before the 30th of September because you listened to a webinar and you got really excited about Steve's enthusiasm and thought you probably should put some more in, is there a vehicle to do that, or do we just wait and through the DRP process or through the automatic process do it that way?
Well, first of all, I need to take a closer look under your couch next time I'm lucky enough to stay with you, because obviously that's where the money's hidden. But I would say
On to me.
no. I did a top up for each of my girls today. What you do is you go, if you can hang around a little bit longer, I'll show you how to do a top up on the next bit. It's really easy.
Okay, great.
All right,
Thanks.
cool. All right, there's Sharon. Sharon's hand down. All right, so no one else put their hand up, please. We'll go Sean, John, Matthew, Joseph, and then I'll have a short break, and then we'll jump on to the next bit if you're able to hang around. So let's start with Sean. Hi, Sean. Oh, Sean's just gone away at the last second. Are you there, Sean? I can hear myself. All right, Sean's popped his hand down. Let's go to John next. Hi, John.
Hi, Steve.
Good evening.
I've got a couple of questions.
Yeah.
Hi. I've been with the US fund since day dot. In the early years, there was a gentleman in the US. I believe his name was Aaron, and he was responsible for acquisition. Is that essentially the role that you will be jumping in for this fund?
Not quite the same role as what Aaron did, knowing intimately what Aaron's role was because he reported to me, but a role similar-ish to it, yes.
Okay. And my second question is, a few years ago, one of the funnest parts of being in the US fund was watching on the live webcam a Starbucks being built on one of our properties. My question is, will property development or property value add as a developer be sort of in the strategy of your inefficient asset space?
Not to buy and sell, to buy and hold possibly. If you end up being a trading trust, which is developer buy to sell, there are all sorts of nasty tax consequences that can be triggered. So if we do any developing, I'll give you an example. Let's say we find a building which is half complete and we want to jump in because we can buy it for cents in the dollar, and we decide we want to complete it as a development project and build and bank the developer's margin, but then rent it out once it's complete, then we, theoretically might do something like that. Or, there's no reason why, if we had a tenant and we could build to spec for that tenant like we did for Starbucks in the US, that we wouldn't do that again either. But I'm not saying we will. That's not front of mind about how I think we're going to deploy in the inefficient space. It's possible, but it's not where I think we'll be.
Okay, awesome. Thank you.
All right, no worries. All right, let's go to Matthew next. Hey, Matthew.
Hey, Steve, how you going?
Good evening. What's your question, mate?
Mate, quick one. I've been in the US fund as well, and great job you've done with that. I'll be looking to roll over into this new program. But the question I've got is, due to having just built a house, which is bloody expensive at this time of the world, money's not great. I'm wondering whether SMSF is also an option to invest into this new fund.
Have you got your own super fund at the moment, or you'd set it up?
We're about to set it up.
I mean, lots of people have invested in their self-managed super fund. My own self-managed super fund will be an investor in this, as it was with the US fund. The problem with self-managed super funds is you've got to look at the cost versus the return. Like if this was your only asset in the self-managed super fund and it costs you $2 or $3 grand a year to get your super fund audited, and you're only going to put in 50 grand, then the cost to benefit of doing so may not be there. So you've kind of got to weigh it up.
Yep, okay.
So I'm not giving you advice
it.
about whether to do it or not. I'm just saying from a principle point of view, you have to, for a self-managed super fund, normally you need a couple of $100 grand to make it worth your while.
Yep.
And then if you're going to put all of it in this, you have to look at what your investment strategy is and justify as a trustee of the fund why that makes sense.
Okay, cool. Okay, thank you.
All right, cool. All right, Matthew, that's you. Joseph, we're going to come to you and finish with you if you wanted to say something.
Good evening, Steve. Can you hear me?
I can. You're just very quiet, so you might have to yell.
Yes, I will. Steve, quick question very similar to that of Matthew. Can I roll my standard super fund, shut that down, collect the money and put it into Soga?
Okay, so if you've got money in, say, an industry fund, you're not going to be able to invest in this because we won't be on their approved product list. And to get on their approved product list is time consuming and very expensive, which isn't where we want to be. So depending on how much money you've got in your superannuation elsewhere, the cost of setting up a self-managed super fund is $3 to $5 grand, but then it's probably another $2 to $3 grand a year to have it audited and tax returns and that kind of thing. So you have to weigh up whether the cost of setting up and administering it makes it worthwhile for simply being wanting to deploy your money into this investment.